Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and thank you for joining me for another episode where we break down the financial markets into practical, actionable insights that traders and investors can actually use. Today, we're exploring a topic that becomes increasingly important whenever markets transition from one economic phase to another. That topic is sector rotation strategy for 2026. Whether you're a long-term investor, a swing trader, or someone who simply wants to understand why certain industries suddenly outperform while others seem to lose momentum, this episode is for you. One of the biggest misconceptions in investing is that the stock market moves as one single entity. In reality, it doesn't. While headlines often focus on whether the S and AMP wink with tongue sticking out 500 or NASDAQ is up or down, what's happening beneath the surface is often far more interesting. Money is constantly flowing from one part of the market to another. 1 month technology stocks may be leading, then suddenly financials begin outperforming. A few months later, energy companies or healthcare stocks take center stage. Understanding these shifts is what sector rotation strategy is all about. Instead of chasing yesterday's winners, successful investors attempt to identify where institutional money is likely to flow next by aligning sectors with macro trends. Let's dive into what that actually means. What is sector rotation? Sector rotation is the process of moving investments between different industries as economic conditions evolve. Rather than allocating capital equally across every sector regardless of market conditions, investors adjust their portfolios based on where they believe the economy is heading. The major stock market sectors include technology, healthcare, financials, industrials, energy, materials, consumer discretionary, consumer staples, utilities, communication services, and real estate. Each sector reacts differently to economic conditions. Technology companies often thrive during periods of innovation and economic expansion. Financial institutions tend to benefit when lending activity increases and interest rate environments become more favorable. Energy companies may outperform when oil prices rise or inflation remains elevated. Healthcare and consumer staples frequently become more attractive during periods of economic uncertainty because demand for their products tends to remain relatively stable regardless of economic conditions. This constant movement of capital is what creates opportunities for investors who understand macroeconomic trends. Why sector rotation matters in 2026. Looking ahead to 2026, markets are entering another fascinating period. We're continuing to see the long-term effects of higher interest rates, artificial intelligence investment, infrastructure spending, changing global supply chains, geopolitical uncertainty, and evolving central bank policies. Each of these factors influences different sectors in unique ways. Artificial intelligence continues creating enormous investment opportunities, but it isn't only technology companies benefiting. AI is transforming manufacturing, healthcare, logistics, cybersecurity, financial services, and even energy production. Meanwhile, governments around the world continue investing heavily in infrastructure, renewable energy, semiconductor manufacturing, and digital transformation. At the same time, inflation remains an important consideration. Even if inflation moderates compared to previous years, investors still need to monitor pricing pressures because they directly impact corporate profitability and sector performance. This is why aligning sectors with macro trends has become one of the most valuable approaches for navigating today's markets. Understanding the business cycle. Every successful sector rotation strategy starts with understanding the business cycle. Although every economic cycle is unique, economies generally move through several recognizable stages. The first stage is recovery. Following periods of slower economic growth or recession, central banks often lower interest rates, businesses begin hiring again, consumer confidence improves, and economic activity gradually accelerates. During this phase, technology companies, industrial businesses, and consumer discretionary stocks frequently perform well because investors anticipate improving corporate earnings. As recovery transitions into expansion, economic growth becomes stronger. Businesses invest more heavily, manufacturing activity increases, employment improves, and consumer spending continues rising. Financial institutions often benefit during this stage because lending activity expands alongside broader economic growth. Industrials also perform well as companies increase production to meet growing demand. Eventually, economies enter a later stage of expansion. Inflation pressures may begin building. Commodity prices can increase. Labor markets tighten. Businesses with strong pricing power become increasingly valuable. Historically, sectors like energy, materials, and selected financial companies often outperform during this environment. Eventually, however, economic growth begins slowing. Perhaps higher interest rates reduce borrowing. Maybe consumer spending weakens. Or perhaps geopolitical events create uncertainty. When this happens, investors often rotate toward more defensive sectors: healthcare, utilities, consumer staples. These businesses tend to generate relatively stable earnings regardless of broader economic conditions. Understanding where the economy currently sits within this cycle helps investors make more informed portfolio decisions. Hashtag which economic indicators should investors watch? One question I receive frequently is this: what economic indicators matter most? Let's go through several of the big ones. Interest rates remain one of the largest market drivers. Lower interest rates generally benefit growth-oriented companies because borrowing becomes less expensive and future earnings become more valuable in today's dollars. Higher rates may create opportunities for banks and financial institutions while placing pressure on highly valued growth companies. Inflation is another critical variable. Moderate inflation isn't necessarily harmful. However, persistent inflation can significantly impact company profit margins. Energy producers and materials companies often perform relatively well during inflationary periods because commodity prices frequently rise alongside inflation. Employment data also deserves attention. Strong employment supports consumer spending, housing activity, travel, entertainment, and retail businesses. Weak employment often signals slowing economic momentum. Corporate earnings remain perhaps the single most important long-term driver of stock prices. Professional investors spend enormous amounts of time analyzing earnings guidance because earnings expectations frequently determine where institutional capital flows next. Manufacturing data, purchasing managers' indexes, consumer confidence reports, retail sales, and housing statistics also provide valuable insight into economic momentum. No single indicator tells the complete story. Successful investors combine multiple sources of information before making investment decisions. Artificial intelligence is changing more than technology. Artificial intelligence deserves special attention because it's reshaping nearly every sector. Many people assume AI only benefits technology companies. That simply isn't true. Healthcare companies are using AI to improve diagnostics and accelerate drug discovery. Financial institutions are using AI for fraud detection, algorithmic trading, and customer service. Manufacturers are increasing productivity through automation. Logistics companies are optimizing global supply chains. Retailers are improving inventory management. Cybersecurity firms are developing increasingly sophisticated threat detection systems. Even agriculture and energy companies are integrating artificial intelligence into their operations. This broader adoption means investors should think beyond traditional technology stocks when evaluating AI opportunities. Common sector rotation mistakes. Let's also discuss several mistakes investors commonly make. The first is chasing performance. Many investors buy sectors only after they have already experienced significant gains. By the time financial media begins heavily discussing one sector, much of the easy money may already have been made. Another mistake is ignoring valuation. Excellent companies can become expensive. Strong sectors can become overvalued. Eventually, even great businesses experience periods of consolidation while investors rotate toward industries offering better relative value. Some investors also rotate portfolios far too frequently. Markets produce constant noise. Not every headline deserves a portfolio adjustment. Successful sector rotation focuses on meaningful macroeconomic changes rather than reacting emotionally to daily market volatility. Finally, diversification remains essential. Sector rotation isn't about placing all your investments into whichever industry appears strongest. Instead, It's about gradually adjusting portfolio weightings while maintaining sensible risk management. Building your own sector rotation strategy. So, how can individual investors build a practical sector rotation strategy 2026? Start by monitoring major economic reports every month. Pay attention to inflation, employment, interest rates, GDP growth, corporate earnings. Watch how different sectors perform relative to the broader market. Are industrial stocks beginning to outperform? Are financial companies strengthening? Is healthcare becoming more resilient? These relative strength trends often provide valuable clues about institutional positioning. Review central bank commentary. Monitor fiscal policy. Pay attention to geopolitical developments. Most importantly, remain patient. Sector rotation isn't about predicting every market move. It's about steadily positioning your portfolio where economic conditions appear increasingly supportive. Never stop learning. Financial markets constantly evolve. New technologies emerge. Governments introduce new regulations. Economic conditions change. Successful investors recognize that continuous learning is one of their greatest competitive advantages. If you're interested in expanding your understanding of trading, investing, macroeconomics, and financial markets, I highly recommend exploring the beginner friendly educational content available through the Crystal Ball Markets podcast. You can listen here, rss.com/podcast/Crystal Ball Markets. Their episodes cover everything from market psychology and technical analysis to macroeconomic trends and investment strategies, making them an excellent resource for both new and experienced investors. Use better trading tools. Education is important, but having the right trading platform is equally valuable. Whether you're monitoring sector performance, analyzing market trends, or executing trades efficiently, professional grade tools can significantly improve your decision making process. If you're looking for a world class, cutting edge, user friendly trading platform, visit crystalbellmarkets.com/platform. Having access to powerful charting, market analysis tools, and an intuitive trading experience can make implementing a sector rotation strategy much easier. Final thoughts. As we wrap up today's episode, remember this: markets are constantly changing, leadership rotates, economic conditions evolve. What worked yesterday may not be the strongest opportunity tomorrow. Rather than chasing headlines, focus on understanding the broader macroeconomic picture. Monitor economic indicators, study corporate earnings, observe sector leadership, manage risk carefully, and most importantly, remain flexible enough to adapt as market conditions change. A disciplined sector rotation strategy isn't about predicting the future with certainty. It's about improving your probability of success by aligning sectors with macro trends and allowing the market itself to confirm where capital is flowing. Thank you so much for listening to Financial Market Insights for Traders. I'm Sophia, and I truly appreciate you spending part of your day with me. If you enjoyed today's episode, please follow the show, share it with fellow traders and investors, and join me again next time as we continue exploring the ideas, strategies, and market insights that can help you become a more informed and confident investor. Until next time, trade wisely, invest patiently, and always stay curious.